Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, today we're talking about something that could be a real game changer or a real headache come tax time. We're going to break down the premium tax credit. I mean, let's be real, right? The cost of health insurance can be a huge weight on your finances. And if you're anything like me, you're always trying to figure out how to make those monthly payments a little less painful. Well, there's actually some good news. A tax credit exists specifically to help with that very thing. It's designed to potentially save you thousands of dollars on health insurance. But, and this is a big but, it's not just free money. There's a crucial catch. How you manage this credit throughout the year can make or break your tax return. And trust me, you want to get this right. So let's get into it. Okay, so first things first, what exactly is this credit and who's it for? So the premium tax credit, this is a refundable credit. And the most important thing to remember is that it's only for health insurance you buy through the health insurance marketplace. It's all about helping eligible people and their families actually afford their coverage. And it's pretty straightforward, really. It works on a sliding scale. The lower your income is, the bigger your credit is going to be. Simple as that. The whole idea is just to make sure more people can get covered without breaking the bank. Okay, so how do you actually get your hands on this money? Well, you've got a couple of options here, and the choice you make is a pretty big deal. So the question for you is, how do you want your credit? Do you want that help spread out month by month, or would you rather get a bigger payout at tax time? Let's look at what that means. So here are your two paths. Option one, which is what most people do, is to lower your monthly bills. You get what are called advance payments, or APTC, and they go straight to your insurance company. Boom, your premium is lower right away. Option two, get a bigger tax refund. You pay the full premium all year long and then claim the entire credit when you file your taxes. Could mean a nice big refund. Okay, now this is where that catch I mentioned comes in. If you take those advance payments, the amount you get is based on an estimate. That's the key word here. The marketplace is basically guessing what your credit should be based on what you think your income and family will look like for the entire year. And you know what happens with estimates, right? Life happens. Things change. And that initial guess can become outdated and fast. This is why it is absolutely crucial that you report any life changes to the marketplace. Seriously, you have to do this as soon as things change. If you don't, you could be setting yourself up for a major headache later on. So what kind of changes are we talking about? Well, income changes. For one, getting a new job or a raise. That's obvious. But it could also be receiving a lump sum payment or even cashing out some investments and realizing capital gains. And get this, even if a credit card company forgives a bunch of your debt, that can count as income. All that stuff, you got to report it. And it's not just about the money coming in either. Your household can change too. Did you get married or divorced? Have a baby? Did you suddenly get an offer for insurance through a new job? Or maybe you just moved to a new address? All of these things can change how much credit you're supposed to get. So yeah, report those too. So you've been reporting your changes all year. Or maybe you haven't. Either way, it all comes to a head at tax time. This is the moment of truth. This is the reconciliation. Yup, when you file your taxes, you have to reconcile everything. It just means you're going to compare the total advance payments you got all year with the credit you actually qualified for based on your final real numbers. It's the estimate versus reality. Now, you don't have to pull these numbers out of thin air. The marketplace will mail you a form. It's called Form 1095A. Keep an eye out for it. It has all the info you need, what you paid, how much you got in advance credit, the works. You'll take those numbers and plug them into another form, Form 8962, when you do your taxes. So when you do that reconciliation, it can go one of two ways. Let's say you estimated too low. Your income was less than you thought. Great news. Your actual credit is more than what you got in advance, and that extra money gets added right to your tax refund. But what if you estimated too high? Well, if your income was more than you projected, your actual credit is less than the payments you got. And that means you have to pay back the difference. Now listen up, because this part is so important. For tax years after 2025, there is no cap on how much you might have to repay. Let me say that again, no cap. That means if you got way too much in advance payments, you could be on the hook for paying back the entire excess amount. And that could be a huge unexpected tax bill. Okay, now that we've covered that, let's back up a little. Who's even eligible for this credit in the first place? Let's do a quick check. It's a pretty basic checklist. First, you have to get your insurance through the marketplace. Second, you can't be claimed as a dependent on someone else's taxes. Third, if you're married, you generally have to file jointly. And finally, you can't already be eligible for other affordable coverage, like from your job or Medicare. And of course, the big one is income. Generally, to qualify, your household income has to be under 400% of the federal poverty line for your family size. But there's a really important temporary rule change going on right now. For the tax years 2021 all the way through 2025, that 400% income cap has been eliminated. So what does that mean? It means that even if you have a higher income, you might still be able to get some help, which is a huge deal for a lot of people. So that brings us to the final question, and this one's for you. Now that you know all this, is your marketplace estimate still accurate for your life today? The biggest takeaway here is to keep your info current. Take a moment and think, based on what's happened this year, is that estimate you made still on track? A few minutes updating your account now could literally save you from a huge financial surprise at tax time.